So please take your seats fast. Okay. So let's start. So we just go to the site and pick up any fund. Suppose I'm picking up low duration fund. It was normally recommended that put your money in low duration fund during my time when I was investing. So I picked up that only. But you can choose anything. As I told you that you know now when to invest in which kind of a fund. So let's talk about low duration. Of course, you can even choose a liquid fund. And just last week I put a lot of money in liquid funds also. So what I'm going to do, I'm going to the returns. Okay, fine. So just do the same thing which I'm doing along with me. Okay, so here we are. So please sit down fast. I don't want any movement. Okay. So debt funds, we are in the debt funds, and we are just picking up, the returns first of all. So what I'm doing is I'm going to returns. Okay, and picking up. I'm just going to download the returns here. So low duration funds, these mutual funds select the bond debt for investment, such as the average maturity period for the portfolio is between 6 to 12 months. So you download the data. Okay, somehow I'm getting some issue here. So I have already downloaded it. Okay, so I'm just going to go there. नहीं आ रहा आपको पास डेटा नहीं हाँ ये नीचे क्यों नहीं आ रहा इसके हाँ ये देखना एनुअल ओके अच्छा तो ये एनुअल आ रहा है ना बट वी वांट हिस्टोरिकल रिटर्न्स ओके so I'm just going to there's some problem there so I'm just going to take out the returns from here okay ये फाइनेंशियल एनालिटिक्स कहाँ है अच्छा आपका हो गया हाँ ग्रुप पे है दे दो और रिस्क वाला भी निकाल लो आगे वाला रिस्क है लो ड्यूरेशन में आपको यू विल फाइंड if you go to historical returns so it is not populating here okay हाँ रिस्क रेशियोज दोनों चीज भेज दो आप ये भेज दिया आपने हिस्टोरिकल रिटर्न्स ओके हाँ अच्छा अच्छा नहीं मेरे अकाउंट से नहीं होता है तो सिंपल है ये तो इसमें आपको करने की जरूरत नहीं है ओके सो दिस इज कॉल्ड द रिटर्न्स ओके और एक और निकालिए रिस्क वाला उसके साथ में रिस्क दिया होगा ना ये जो आ रहा है रिस्क रेशियोज इसको डाउनलोड करो हाँ ये तो दे रहा है यहाँ पर तो ये तो दे रहा है मैं इसको डाउनलोड कर देता हूँ सो आई एम डाउनलोडिंग तो रिस्क वाला मेरे पास आ गया कोई प्रॉब्लम हाँ ओके एक रिस्क है ये वाला है ना सो रिस्क वाला आप चाहते हो कि मैं आपको भेजूं आगे आपका भेज दिया मैंने ओके गॉट इट So we have now both risk as well as returns, risk ratios. और वो कहाँ गया, हिस्टोरिकल वाला कहाँ है? हाँ ये था, तो मैं इसको हटा देता हूँ. So now I have this historical returns. Okay, so I'll just name it returns. Okay, and make another Excel sheet बना लेता हूँ, यहाँ बना लेता हूँ risk. Okay, fine. डायरेक्ट प्लान बोला ना. अच्छा, अब इसमें आप जो है टॉप लाइन हटा दो, डिलीट कर दो. ओके, एंड दिस डायरेक्ट प्लान, और ये तो हमें पता ही है, इसको भी आप डिलीट कर दो. ओके, फाइन. एंड देन चूज एवरीथिंग up to 10 years. Okay, and make control T and make it the color you like. Okay, and और एक चीज ध्यान रखें, ये फिगर जो है ये वाला, क्योंकि these are debt returns, इसको आप डेसिमल प्लेसेस थोड़ा सा बढ़ा दो, 2 तक ले लो. ओके, और 1 तक ले लो तो बेटर है, या जो भी ले लो, 2 तक ले लो, चलो. बिकॉज में रिटर्न्स कम होती हैं, तो इसलिए बेटर दैट है कि आप हम कंप्लीट रिटर्न देखें. ओके, फाइन. सो नाउ वी हैव द रिटर्न्स फॉर, पहला क्या है, आईसीआईसीआई प्रूडेंशियल, क्राइसिल रैंक 5, AUM 22,000. That means 22,000 crores have been invested in this plan. YTM, it is giving you a figure, something called YTM, yield to maturity. Okay, it means it is telling you that the average yield to maturity of all the funds which has been invested under this plan, the yield to maturity is 7.74. Now we, in the morning, we understood how to calculate the YTM. We calculated YTM for a particular bond. Now here this guy has invested into 50 bonds, okay, kind of 50 securities. So he's telling you what is the average YTM. Okay, this is an average YTM of all the bonds he's possessing. So which means what? Please listen to me very carefully. If the fund manager doesn't do anything, okay, remains with the portfolio, you are going to get 7.74% return at the end of the period of the bond. Okay, so if you hold the bond for example, this is a low duration bond, which is the period is around 1 to 2 years, for example. So if you hold the bond for 2 years, you are going to get 7.74%. If the fund manager is not going to sell it before the maturity, अगर बेच दिया तो फिर profit loss book कर दिया उसने, isn't it? So in some cases he has to sell, because maybe that there is a redemption pressure, because of that he might sell. Okay, but if he holds the bond till maturity, then you are going to get 7. Now what is the return for 1 year? Return is 7.58, very close to yield to maturity. If you have done this exercise a year back, the 1 year return was only 4%. Fine, I'll just show you that numbers. So अभी तो ये क्योंकि returns जो है close to maturity period ही आ रहे हैं, YTM से आ रहे हैं. Okay, 2 year, now look at 2 year. 2 year is telling you 5.77%. Fine. If you have bought this bond and held for 2 years, your return was only 5.77, below the YTM. Okay, and similarly 10-year bond, 10-year period, it is giving you 7.76. So now since you hold the bond, for example, you want to know what is my 1 year के tenure पे देखें आप, तो 1 year पे हम उसको largest to small कर लेते हैं. Now normally a person who will be buying bonds, his vision will be for 1 or 2 years, something like that. Okay, because that is a low duration period. Okay, so which bond is giving you the highest? SDFC low duration. Fine. Then followed by ICICI, then Aditya Birla, and then Kotak, HSBC, and the final Kotak low duration. So actually I put a lot of money in Kotak low duration, which is giving you almost like 5.84, and 1 year is about 6.7%. So I put almost like 50 lakh rupees or maybe 1 crore rupees at one point of time in Kotak low duration, which was being the most popular bond. Okay, fine. Now go to risk and copy your risk from there. You can just delete the top line and just, and even delete your this duration, okay, and copy the entire sheet and take it to the historical return. And take it here and paste it. Okay, fine. और ये कैट सी कॉलम वाला भी मैं इसको हटा देता हूँ because we know this all low duration bonds. And then I'm just going to put a and Control T. Okay, now as I told you, the for bonds, for debt related mutual fund, it is the duration, and Macaulay duration is very important. Fine. But in this risk ratios, he has not used that. Okay. Fine. So that is the only thing, because he has used only one way of evaluating a equity fund as well as a debt fund, ignoring the duration concepts. Okay. Fine. So anyway, no problems. We know what is duration. So now the same way which we have done for equity, we are going to see the for example if we have to analyze, the highest Sharpe ratio would be the best one. So the Sharpe ratio is negative. Okay. Okay. Jensen alpha is 0.59. Just go to Jensen alpha, for example, 0.59. Now here, again, because higher the Sharpe ratio is better, but here the Sharpe ratio itself is coming to negative. Okay, that means this return is lesser than the benchmark return, which will mean that, okay, sorry, the Sharpe ratio, what we take? The risk-free rate. Okay, that means the return given by the fund minus the RF divided by the standard deviation. Is that the formula for Sharpe ratio? Do you all remember? It is basically the return given by the fund minus the risk-free rate divided by the standard deviation. Now, how the figure will be minus? If the risk-free rate is higher, okay, and the return given by the fund is lower, fine. So that means this fund is, all the funds are giving lower than the risk-free rate. We can presume that, okay. Like, UTI, what was this? UTI low duration. So we can check UTI low duration. Okay, we can just, sort from A to Z and see, how much UTI has given. UTI has given a return for 1 year, which is close to 7.17. Okay. So that means it is lower than the risk-free rate, isn't it? Now, if you want to check what is the risk-free rate, so I'll just, go to this thing, the file which you opened in the morning, this one. Okay. And go to the first slide. I've given a link there, a 10-year bond. Okay. So we just copy this link and open up the site. Tenure. Okay. So today the 10-year bond is giving you 7.264. This is the YTM of a 10-year bond. Okay. And how much the UTI is given? 7.16 or something, isn't it? So that's why it's coming minus. So this was just to explain that. That's why I opened this. Now, let's understand a little bit further. So this is a 10-year bond. The government can issue bonds for 5 years, 10 years, whatever. Okay, fine. So this is, how the yield to maturity of the bonds have behaved over the years. Okay. So this is from November 17 till November 21 year period. So this graph is showing what is going up. So that means interest rate started going up again. Why? There is an inflation in America, okay, and which is having some impact in India also. Our inflation is not going up so much, but still the bond yields have started looking up higher, okay, after the war from, Israel and Hamas war. So it has adversely impacted the yields, okay. So the yields have started going up. Normally the interest, when the inflation goes up, the yields also go up. That means the interest rates will start going up, okay. In that FDI rates have also gone up, okay, because FDI rates will actually depend upon this government yield only. This is the the moot point. From here only everything will go up. So this is the starting point. ये नहीं कि FD बढ़े तो इसका बढ़ गया. FD, because the yield has gone up, because the government is borrowing today. Government is a big borrower. borrows almost to the tune of about 10 to 12,000 crores per week. Okay. So they determine the interest rates of the country, whether the interest rates of FD, whether the interest rate what the corporate world is going to charge. It depends upon the government, at what rate the government is borrowing. The government heavily borrows. Okay. Government requires a lot of money. When the budget is passed, at the end, the finance minister tells you that this is the budget deficit, fiscal deficit, 4%, 5%, 6%. Okay. So then they say that we are going to borrow so much of money, 5 lakh crore, 6 lakh crore per annum in the next year. That's my borrowing program. Okay. So the government is the biggest borrower, determines the lending rate of the entire country of any kind of instrument that are. So a 10-year bond becomes the one of the basics for that, because generally when we compare with the equity markets, equity is a long-term investing, so we always compare with the 10-year bond. Then it makes a good comparison. That's why the 10-year bond becomes the benchmark bond. Okay. Now that means this bond was issued at a coupon rate of 7.18%. Look at this. This bond was issued at 7 and maturing in 2033. This is a 10-year bond, and currently it's 7.264, which means the bond prices have become below the face value, 99 something. Okay, fine. Okay, and then there was one more, this thing, second वाला, इसको भी खोल लेते हैं. And just open the second one also. So this is basically, telling you the rates for all the tenure of bonds, 3-month bond, 6-month bond, like this, it's going up to, 30-year bond. Government can issue bonds for 30 years also. Okay. Now look at the rate of interest. What is the yield for a 3-month bond? 6.9. And what is the yield for a 10-year, 40-year bond? 7. Which is higher? 40-year. Now these bonds are risk-free bonds. Please listen to me, very important concept. Now the bond which is very short duration will carry a little lesser, return. The bond which is having the highest 40-year will carry a higher return. Though returns are, the government bond is a risk-free for us. We are not going to lose any money. Then why the interest rate is higher for a 40-year bond? Suppose I have to lend money to someone for 1 year or 40 years. If he says, give me money for 40 years, if I'm lending for 1 year at 7%, so I'll say, give me 8% for 40 years, because we don't know what will happen. So as the time expands, the interest rates goes up. So that's why the bond will always carry a long duration bond will carry a high, interest compared to a short duration. Okay. So if we plot a graph, at like this, it will be an upward sloping graph. So this starts from 6 months, 1 year, 2 year, 3 year, like this, and 40 year. So it will be upward. As we go in the 40th year, Jalak, please watch, okay? Palak. Jalak, hai? Okay. So a 40-year bond will carry a higher coupon rate or high yield to maturity compared to a 6-month bond. If that is the graph, if this is the setting for India, it's a wonderful setting. We say it's a normal yield curve. If the yield, it's an upward sloping. If it becomes downward sloping, where the short-term yield is higher and a long-term yield is lower, then we say it's become inverted. It's a sign of recession. Many of the past recessions in the world have been predicted on the basis of yield curves. It happened in 2007. If you go back on a YouTube and try it, and I've just shared some, this thing on the links to the thing. So there was actually on YouTube, there's a wonderful, this thing. In 2006 and 7, the US yield curve started inverting. Stock market is at the top. And there's a warning given that we are going to in a very bad state. Okay, many of the economists, they gave a kind of a, warning to the stock markets, the equity investors, that don't invest because you're going to lose. And then the stock market crashed 60% from its peak. Indian market was at 22,000 Sensex, it came down to 8,000. I started investing at that time. I invested some 30 lakh rupees, it became 1 crore. And I thought I'll just leave the job and I'll make my earning from the stock market. But 2008, the crash taught me a lesson, because the 10 lakhs, say 1 crore, and I came back to almost 10 lakhs again in a matter of just 3 months. Okay. So that was a crash that you can't rely on the markets alone on your earnings. Okay. Fine. But definitely on a long term, because after that, after 3 years, the market went up again. So my 10 lakhs became 1 crore again. Okay. So that kind of a thing which happens only once or twice in your lifetime, maybe once in a lifetime. वो एक ही दफा हो सकता है. It happened in 1930, Great Recession, which happened in the world, and then it happened in 2007 when there was a great meltdown. So whenever the markets fall about 10 to 20%, the economists are saying, are we going to witness back 2007? Then, many people say, no, it's not like that. The settings of 2007 were totally different, subprime crisis and everything. We are not in that kind of a precarious situation. It is normal upturn, normal up and down things which are happening in the market. It's not that severe as it which happened in 2007. So these are basically learnings of the yield curve. So you just go back in your home and research the topic yield curve and go through my videos, okay? And just pick up and see if you can locate 2007 when the meltdown happened. And that graph, is telling you as the time is crossing, they're actually telling you how the yield curve is inverting, okay? When the yield curves fully invert, that means recession has begun in America. Yeah, उस time में शुरू हो चुका था. But it was quite evident to the people now we are in recession. Okay, fine. Okay, so coming back to this, now we have the risk ratios, and now we can just I mean, of course we have a standard deviation, we have a Sharpe ratio, we have a Jensen alpha, we have a Treynor ratio, fine. And Sharpe ratio is giving you negative because the return is lower than the risk-free rate, isn't it? Fine. So then Jensen alpha, if you look at the Jensen alpha, then the UTI, low duration is the best because it has actually giving you a higher return than the benchmark. We all know that, okay? And Treynor ratio. So now in your exam, there will be a lot of data will be given to you, and you have to say that where you're going to put your money in, okay? And which ratio is better, Sharpe ratio, Treynor ratio, or Jensen alpha. So it is not that what ratio is better. Actually, you have to look at the situation. Okay, all the ratios have a different significance, and each has different meaning. Okay, and there is no direct answer which ratio is better or which is not. Okay, so maybe sometime you'll say Jensen alpha is better because at least it is beating the benchmark. All other funds are not. So your view can be that. Your view will depend upon how you look at the data. Okay, and all depends upon your further research which you are going to do in your life. Okay, so